Well, the expected surge in supply is materializing. However, lower gas power generation, cheap coal, and strong renewables growth have constrained growth in global gas consumption, now expected to stand at 1.5% between 2015 and 2020. This compares with around 2.5% growth over the previous 5 years. Over the same period, LNG export capacity will likely increase by 45%, 90% of which originates from the United States and Australia. So it remains to be seen how the markets will absorb incremental supply. Long-established markets for LNG are stagnating. Demand in Japan and Korea, which today account for 50% of global LNG imports, could decline depending on the scale of nuclear comeback, efficiency gains, and competition from renewables. Europe's flexibility to take in additional LNG is limited by slow economic growth, cheap coal, and competitive Russian pipeline gas supplies. Suppliers' hopes are in China, where intake has doubled since 2012, even though demand is lower than initial estimates. The good news for LNG exporter is that domestic supply targets and competing pipeline schedules are slipping in China, from shale operations to the Siberian gas import pipeline. India has huge potential, with the government forecasting demand to triple by 2020. However, capped by midstream infrastructure, natural gas use has been declining over the past 4 years, which suggests a bit of optimism in these forecasts. Australian and US facilities are likely to feel the deceleration in gas consumption. Large buyers who have found themselves overcontracted are renegotiating contracts to lower intake prices and volumes. This pushes excess cargoes into the spot market, forcing prices down there as well. So spot prices in Asia have tumbled 75% from $20 per million BTU in early 2014 to below $5 currently. Most Australian projects have long-term sales agreements that significantly reduce the commercial risk. And so the wave of startups in Australia will see gas exports almost double to the end of the decade. US-based projects, which typically offer tolling-based agreements, the absence of contractual destination clauses, and the delinking from oil prices, will remain attractive and exercise more flexibility to meet demand in the spot market. American exporters have a good chance then to become swing suppliers and secure a strong market share in European LNG imports. However, these facilities will be inherently exposed to price volatility in the spot markets.